All-time highs, frothy, high valuations. Those are terms dominating the financial news, and it has the power to strike fear in investors' hearts that a stock market bubble is being created. Add to that noise the comparisons being made to the dot-com bubble of the late 90s and the bursting of said bubble, and it may push investors out of the market completely. Well, hit the pause button. In this week's Fastest 4 Minutes in Finance, insight from LPL Research on how the optimism over AI is not quite the same as the exuberance over the internet. Hello, and thanks for watching. I'm Scott Inman. ChatGPT was released in 2022, thus beginning the AI rally. The S&P 500 index is up more than 75% in the past 3 years, fueled by expectation that this new technology will revolutionize everyday life, corporate business models, the workforce, and even supply chains. The same expectation was created in the 1990s by the internet. The bubble burst in 2000. So how do the two eras compare? One of the most common measurements used to determine if stocks are overvalued is the PE ratio. That stands for price to earnings. It is calculated by dividing a company's current stock price by its earnings per share. The forward price to earnings ratio for the S&P 500 is currently 22.2. That's lower than the 23.8 the index hit during the dot-com bubble. It's even lower than December of 2020, when earnings were depressed coming out of the COVID-19 pandemic. But let's dig a little deeper. Here's an LPL Research chart showing historical PE ratios for the index, but it also overlays historical price-to-book ratios, which compares a company's stock price to its book value, and price-to-sale ratios, comparing it to its revenue. You can see both of those measurements are considerably higher than at any time in the past 30 years, and that's a good thing. It shows S&P 500 companies are way more profitable than during the dot-com era, which LPL Research says warrants higher valuations. LPL says one of the biggest differences between the AI boom and the dot-com boom is that companies investing in AI are doing so mostly with strong cash flows, not through the revenue from AI or by issuing debt or equity. And that wasn't the case in the 90s. LPL summarizes that the AI rally is better capitalized than the 1990s dot-com rally and appears more durable and profitable in comparison. And here's the bottom line. Fear should never drive our investment decisions. A diversified portfolio and a written financial plan are the best ways to counter it. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.